Andrew and Chris. Gents, do you want to just give a brief introduction to yourselves? You're both on mute, I think, by the way.
Shall I go first?
Yeah, go for it.
Okay.
Absolutely.
Thank you. So I'm Andrew Webster. I'm an investment director at Berengier, with responsibility for our estate planning service, which we call PEPS, the Proven Estate Planning Service. My background is I spent many years working within banks as a corporate lender, stroke lessor, and more recently have transferred over to the sort of private debt side of the world. So that's me, Chris.
Hi, my name is Chris Carlson. I'm an investment director with Armstrong Capital, and Armstrong is one of the joint venture partners alongside Berenjea in the Proven Estate Planning Service. I run the solar products at Armstrong, and they are both inheritance tax funds, which make up part of the Proven Estate Planning Service. I've had about 12 years now in the energy transition and renewable space. Prior to working for Armstrong, I was 6 years at Octopus and Octopus Renewables, and then before that, Macquarie Bank.
Thanks, gents. Andrew, just a quick reminder, can you just record it if you're not already doing
Yes,
so?
sorry, I probably should have said to Matt, we are recording this session, so I have pressed the record button.
Yeah, great. That's a requirement of your network, by the way, not us, because they want the information afterwards. As I already said, my name's Carl Porter. I'm a BDD here at Berenjea. My background, 34 years in financial services now. I know you probably don't understand that, given I look so youthful. It's not what many people say. And that's across many guises, from starting off in the banking industry, then moving into the IFA space, worked with and for networks on the development side, and also had my own business. So I have walked the same path as you, and been an advisor, built my business up and sold it. Had some time off, and then glutton for punishment, came back to the industry for more. I don't know why. So before we just commence with the webinar, oh, just bear with me for some reason. It's not. There we go. That's just our compliance slide, which we have to put up there, Matt. If I can just ask you, make sure you're on mute. If you have any questions, just pop them in the chat box, and we'll take care of them at the end. And if there's anything that we need to follow up on, we will do that via email after the event. And we're communicating with Mohan at Your Network, who I presume you know. So if there's anything that you need after the event, come direct through to us, or if you want to chat with Mohan, and he'll make sure you're sorted out with that. In terms of learning objectives, I'm going to give you a very brief run through of our VCT. It's not designed to teach you to suck eggs. I appreciate most of you will have a good understanding of that already. But we'll be touching on VCT. The main crux of the presentation today is around business property relief, hence us having Andrew and Chris on the call. So I'll give you a whistle-stop tour of the VCT, and then they'll be taking you through the opportunity in the business relief space. Especially on the back of the recent budget changes there. There's further opportunity in what was already quite a big space. So hopefully we can give you some nuggets about diversification, about the renewable side, hence Chris being here. So hopefully you'll get plenty from the meeting. Just to give you a brief introduction regarding Berenjea, because I do appreciate our footprint hasn't been huge across the UK. There are people that haven't yet heard of us, but we do have a 30-year track record in the tax efficient space. It's now in excess of 900 million in terms of funds under management, and we are a transatlantic venture capital trust investor. So we have offices here in the UK, in London, Drury Lane, and we have an office in Detroit in Michigan. And that really gives us, especially on the VCT side, that gives us quite a unique USP, which I'll explain to you further as we go through through some of the slides. Our funds, as you've already heard, we work in the tax efficient space. We operate in both the VCT and business property relief sectors. So we have two VCTs and we have our proven estate planning service. Just to explain, because I do get asked from time to time, the easiest way to remember it, because we're titled as Beringia UK, as you've already heard. Our products are titled as Proven. So I always say just think of it as a trading style. So it's the Proven VCTs and the Proven Estate Planning Service. Beringia being effectively the fund manager there. But we'll talk you through those products. A little bit of information on the slide there, but we'll go through that in more detail shortly. So, as I said, I'll give you a quick introduction to our VCTs. First and foremost, what are they? Not going to concentrate on this much because I appreciate you'll probably already know it. But VCT is basically an investment company that's listed on the London Stock Exchange. Clients invest into the VCT and the funds are pooled and then invested into early stage startup companies. With ourselves, they're always revenue generating companies, so we don't do anything that's pre-seed. And clients invest in the VCT. In doing so, they get a number of benefits. There are a number of tax reliefs, which I'll talk you through shortly. But you're obviously investing in early stage companies, which is why it's classified as a high risk area to invest in. It's because of that early stage style. When clients invest in a VCT, they get a number of benefits. The main one, and one of the main reasons why clients choose to invest, is to get the 30% income tax relief up front. So depending on the amount of the investment, the maximum being £200,000 per annum, whatever the client invests, they then get 30% tax relief on the back of that. So that's a huge benefit of a VCT, especially where you've got clients that are in and around that £100,000 per annum income bracket. If they're taking it just over, they get significant tax relief to reduce their tax burden. Tax-free dividends as well. So each VCT will distribute dividends each year. We target 5% dividend distribution each year. And when they do that, those dividends are tax-free. So it can be a great supplement for other incomes, especially if you think, for example, where you've got a client coming up to retirement, they may be 5 years from retiring. If they invest in a VCT each year, first one maturing after 5 years, they then just keep reinvesting and reinvesting, and it gives them a tax-free income to support pensions advice. These are the types of things that myself and other members of the development team will discuss with you, those opportunities, those ideas to help you with your planning with your existing clients, because there are a number of different opportunities in this space. There's also no capital gains tax on any gain made through a VCT. And the important feature here is the minimum holding period is 5 years. So for the client to maintain those benefits, those reliefs, they have to remain invested for a minimum 5-year period. And just to make you aware, you probably already know this, but in September last year, the UK government, the Treasury, extended the support for VCTs in terms of the sunset clause. So that was extended from April 25 to go through to 5th of April 2035. Quite simply, that just means that in terms of investors investing into a VCT, they've now got that long-term stability, so they know that it's around for the long term, and those benefits will remain in place for anybody that invests. Just giving you some bit of background into our VCTs, we have 2 of them. The only reason why there are 2, cutting what is a very long story short, is you're probably aware a number of years ago, the Treasury announced limits onto the amounts that any VCT company could invest in one business. To get around that, at that point, we introduced a second VCT. So what you often find is the companies that sit within our portfolio are duly invested through both VCTs VCTs, just with a different asset mix to give the investor as much stability as possible. But where are we? We currently sit with 54 companies in the portfolio. So as you can see, that's we do have a very long-standing track record and a very good record in the space. Assets under management now in excess of 170 million through our VCT, through our proven VCT, and our proven growth and income sits around about 166 at this specific time. What areas do we invest in? We're quite unique in that we're one of very few companies still involved in retail. The main reason for that, and it gives us a very specific USP in that we have the ability with companies that we invest in, we have the ability to take them transatlantic straight away. So we can extract quicker growth. When they're going on that growth curve, we can extract the growth quicker, thereby giving the clients better growth within the portfolio because you're exposing them to much wider markets. And there are some great examples of that. I'll touch on a couple of those later, but I always use Watchfinder, which is a company a lot of people have heard of. So when we invested in them, they were a company that sold second-hand luxury watches. During the process of investment with them right through to exit, which was a very successful exit, that company had been built to have a platform where you, for example, could send your Rolex to them, they'll authenticate it, they'll clean it, they'll sell it for you, and that now happens globally. So as you can gather, the growth through a company like that and through doing what they did was outstanding, and that can be replicated across multiple businesses, which is what we now do, and it's kind of a recession-proof model as well, given that we can demonstrate we've done that at difficult times with a number of companies. Our investment process, just to give you a little bit of information on that, as I've already said, we've got a very experienced management team, a very experienced investment committee, and the due diligence process is extensive, and that extends across to the US and UK. However, one thing I do need to point out is that any investment made through our VCTs here in the UK is ring-fenced in the UK. So there's no compliance worries whatsoever. We have the ability to take the businesses transatlantic, but they are UK-based businesses that our UK VCT invests in. We look for markets that are growing markets. So we won't just, although we're involved in retail, for example, we won't just invest in a business because they've got a great product. We look for businesses that, for example, have some technology that sits behind it that can be expanded across multiple sectors. And again, I always use Uber as a great example of that. So to you and I, it's a taxi company that knows where we are, knows where we're going, and knows how much it costs to get there. But the technology has and continues to expand across multiple sectors like grocery deliveries, like food deliveries. So that's an example of what we look for in terms of the businesses that we invest in. And in terms of the risk management, again, just to point out, one of the key things that we do is we have a member of our investment team that sits on the board of each company we invest in. So we take a very active and a very proactive approach to working with the businesses and making sure that they get the growth that we're looking for. So we always have somebody on the board that will work with that business on making key decisions, which we think is a really important factor of a successful VCT. And what we're looking for is that longevity period as well. And I think one of the key things that advisors look for in that VCT space is where the growth is coming from. And what's important is to understand the timing of the investment. So we currently sit with roughly 47% of the businesses we've invested in that sit in that sweet spot. So they're growing year on year and they're ready for exit in 2-3 years time. So we're in a very good space in terms of where our VCT sits. Mentioned some of the companies, quick case study. I'm not going to go through the ins and out, but again, another great example. This was actually 2 university grads who lived back to back with to each other on their parents' fruit farms. They supplied all the usual local well-known supermarkets, but each week they would get in excess of 45% of the fruit sent back because it was the wrong shape or they felt there was something wrong with it, but it was perfectly good fruit. They started a company where they take that unwanted fruit and they developed a fruit-based sparkling water drink which is completely free of all additives and sugars. So it's a huge and growing market. But if you think of that market in the US, it's kind of, you know, it's substantially bigger than the UK. So that was a great example of where we can extract quicker growth by taking that company transatlantic. And it is a brand that you will see in all your local supermarkets over here, your gyms, etc. And it's a really good story, and it's a business that's growing year on year, as you can see by the revenues there. So in terms of what we're looking for on that growth curve, how we work with them, the markets we can expose them to, it is a key feature of what we do with the businesses to get that success. And again, just to really demonstrate that we've had a high number of exits as well. Monica Vinayde, another great example, which is a jewelry company, which again, we took transatlantic. That was an 8 times return. I think, correct me if I'm wrong, gents, I think Dash was a 9 times, not Dash, sorry. Watchfinder was a 9 times return. So there's been some real good success stories in there. We have had failures as well. We think that that's great because it demonstrates that we've been through that experience. Not everything is rosy in this world, but we learn from that experience, and it gives us key points to look out for in the future. And what you very often find with one of the companies in particular, they had an outstanding product which was service driven, and basically Google swallowed up the market. So it was something that you couldn't really foresee that would happen. But you will always get failures in the VCT space. I think what you're looking for, what I always look for, is a company that has a high number of companies in there, and you're looking for 3 or 4 or 5 companies that can really grow substantially. And in terms of performance, just to give you an idea, we target, like I said, 5% dividend distribution per annum. There's only been 1 year, which was post COVID, and we hit the 4.9% bracket where we haven't achieved that 5% distribution. But that's quite an outstanding record when you consider the amount of years that we've been in that space. And also, it would be fair to point out, you notice on 19 where we had a 28.5% dividend. That was the year. Some of the companies I've mentioned, the likes of Watchfinder, we had a very high number of successful exits in one go, in 1 year, some of which wasn't perhaps forecast. It came quicker than we'd expected. What you then need to do is refill the hopper with those quality businesses ready for exit. So we did have a little dip in the following couple of years. That would be very fair to say. However, it's pretty much wiped its face throughout that period. And that I've just put in there just to give you an idea of some of the brands that we're currently invested in. Some outstanding businesses in there: Farmer J, Dash Water, Gorilla, Lucky Saint, which is a non-alcoholic beer. Although the last time I was in London, I bought one. It cost me £7.50 for a pint of non-alcoholic beer. I wasn't having that again. Not like that up north. Luxury Promise. So there's some really good growing businesses. And what I always recommend to the advisors I speak to is go on our website, proven.co.uk, and have a good look through the information that's on there, both for the VCT and the estate planning service. And one thing that I really would like to get out of today's meet is to say that, look, we do have a pretty open door policy here. Myself and any member of the BDM team will come see you, we'll talk through to you, and we will give you any information you may need at any time and help to support you. And I'm sure Chris and Andrew usually extend that through to themselves as well, if you're looking for key knowledge on solar or what sits behind our asset-backed lending portfolio, for example. So really keen to stress that point. And just finally, which is the reason why I've just quickly run through the VCT, to let you know that we are currently open for business. We opened at the back end of last year, scheduled to close on the 3rd of April with a 30 million raise, minimum investment 5,000. So we're very much at that lower end of the scale. And if you want any further information, I'll make sure that it gets emailed to you after this meeting anyway. But it would be great.
Carl, we've lost you. Hello? We have a technical.
Yeah, I think we might do.
Hang on a second. I'm just going to try and reach him on the...
Can you hear me?
Yep.
Carl, you're back on.
Yeah.
We lost you there for a moment, just as you were talking about that's sort of the wrap up. Hello?
Did you get the offer subscription then?
We're on the subscription. Yes, you started talking about that.
Right. So just to let you know, Matt, the offer is open at this moment in time. We open the back end of 24, scheduled to close at the end of this tax year. Minimum investment 5,000. But if you want any further information, let me know. But I will email you all of the details on both products post this meeting, just so you're aware. Okay, hope that was useful just on the VCT. I'm now going to hand you over to, I think it's Andrew first, who's going to talk you through our business relief proposition and more importantly, some of the opportunities that sit post budget, because it is very much a growing area for a lot of networks. Andrew, over to you.
Thanks very much, Carl. If we can move on to the next slide, please.
Forgot I was doing that then for a second. I was just having a drink.
Okay, all right. So anyway, change of pace now, Matt. We're sort of moving on to estate planning service and what we offer. So, I mean, first of all, you know, what is an estate planning service? I mean, effectively, it gives your clients the ability to access investment in private companies that will qualify for business relief and therefore mitigate any exposure they have to inheritance tax. It's a service that we manage, we at Berengier manage, but we do it in collaboration with our friends at Armstrong Capital. And Chris is on the call, and he'll talk to you more about their role in this service. We have two investment strategies. So the companies that we have on the platform are active in two investment strategies. One is a lending strategy, which I'm personally responsible for. So I spend the money and write the loans that we have on the platform. And we have a solar strategy, which Chris is responsible for. Total amount we've got sort of across the two strategies about 100 million. And we're targeting returns after all costs and fees for the investor of between 4 and 5%. So it's a sort of a modest but steady return that we're targeting for the investors, in addition to the tax benefit that they get on their passing, which is through business relief. Carl? So a little more about the two strategies here. As I said before, the lending strategy we at Berengier manage. We lend to SMEs in the UK, and it's important to recognise that we're focused on the UK. And in terms of SME, I mean, the word SME covers a sort of a multitude of businesses, from sort of small mum and dad kind of cottage industry kind of things to businesses turning over 100 million. We're probably at the smaller end of the M part. So targeting companies with revenues of in excess of 1 million, but probably mostly less than 20 million. That's the sort of target that we look to provide our product to. And we only back revenue generating SMEs. Where they can offer security either through visibility of cash flows or assets that we feel represent good, strong security in the event that things go wrong. And on the solar side, this is led by Armstrong. Again, focusing solely on UK solar only assets. So there's no mix of other more exotic renewable energy assets like anaerobic digestion or tidal technology. It's pure solar. And given the mix of the portfolio that we've got, there's a very good hedge against inflation, as a good proportion, and Chris will go into more details on this, of our revenues from the solar assets are derived from UK government index linked subsidies, which, as I say, provide a sort of a great hedge against inflation. And I think certainly since COVID, we had a big inflation spike. It has come down, but I don't think it's gone away. I think we're going to be exposed to more volatility in terms of inflation over the coming period. So Carl, moving on. this slide really just gives you a bit of an indication as to how it all works. So you identify a client that is suitable for an investment in a business relief product. You select PEPs because you've made a very sensible, wise decision. And we will then look to invest across a number of unlisted companies on the platform. Currently, we've got 3 companies on the platform, 2 solar companies, 1 lending company. And provided that investment remains within those companies for at least 2 years, then inheritance tax relief will be granted to the shareholder on their passing. Now, I'll come on at a later stage to the fact that that has been capped in the most recent budget, but we'll follow up on that in a couple of slides' time. So, Carl, moving on, and again, so inheritance tax. Well, why bother with this? Well, first of all, inheritance tax is a pretty chunky tax. It's levied at 40%, as you probably know. 40% above certain thresholds, and the thresholds are the nil rate band and the residential nil rate band. So certain people, provided they own their own home and provided they're a married couple, could have reliefs or a nil rate band of up to £1 million for a couple. But those reliefs have been frozen for a number of years now, and that has exposed more and more people to inheritance tax. And I mean, just in terms of the government statistics on this, at the beginning of the decade, it was less than £3 billion that were raised from inheritance tax. By the end of the decade, it's going to be more than £9 billion. So there's been a threefold increase in the amount of money that's being raised from inheritance tax from individuals that are passing, and that is clearly exposing a lot more people to this particular tax. Again, Carl, moving on. Now, I think this is a key part of the this presentation. Really, is just focusing on the changes that were announced in the budget. So I mentioned briefly the nil rate band and the residential nil rate band. These thresholds have been increased now to 2030. So they were originally established, I think, in 2007 or 2008. So it would be 23 years with no uptick or no indexation for inflation, which itself is going to capture more and more people within the scope of inheritance tax. Other provisions that were reformed in the budget. First of all, inheritance tax is now going to be levied on pensions from April 2027. So this was being used as a tool to enable people to mitigate their inheritance tax exposure. That is now being closed off for them. A major reform has been in business relief and agricultural relief, whereby business relief is now capped at a certain level, and that's capped at £1 million. 100% relief is now capped at £1 million for all agricultural and business assets, and thereafter the relief is reduced to a 50% relief. What this means is that for people who've got assets of more than £1 million, in addition to the nil rate bands that we talked about before, they will be exposed now to an inheritance tax rate of 20%, i.e. the 40% times 50%. Now that applies to all agricultural and business relief assets, with the exception of what the government has called shares not designated as listed, and what that means in common day parlance, AIM shares. So previously, an investor in AIM or in companies on the AIM market, they will have benefited from business relief at 100%. That now is being capped from zero at 50%. So there's now clear water between investing in a private company and investing in an AIM company as far as business relief is concerned. And the final point, which probably doesn't apply to too many people here, is that there have been some changes in the rules relating to offshore trusts to eliminate any shielding of those assets from inheritance tax. Carl, thank you. So where does that leave us really in terms of business relief? Well, in many terms, the world has got sort of less attractive for all strategies, other than probably a gifting strategy. But business relief in private companies, particularly if your client has got assets that are exposed to inheritance tax of less than $1 million, remain untouched. And it remains a very attractive option, particularly given the fact that the relief compared to gifting is a relief that is available after 2 years rather than after 7 years in a gifting scenario. Also, I think the other important point to remember is that an investment in a business relief, a company qualifying for business relief, does enable that investor to have control of their own money rather than in a gifting scenario where the money has been given away and may be difficult to get back if circumstances change. Carl? What I've tried to do on this slide is look at a number of different strategies just to illustrate the impact of the budget on the amount that will be available to beneficiaries, which is the blue line. I think that's the important line to consider here. So we've got 4 different scenarios here. We've got a scenario which is investing through PEPs in privately held business relief qualifying businesses. We've got an AIM investment, we've got a pension pot, and we've got a do nothing, leave the money in the bank scenario. So you can see, looking at the blue line, that for somebody who has got, again, less than £1 million of assets that will be exposed to inheritance tax, that investing through PEPs in privately held companies is a much more attractive option for the beneficiaries compared to the other options. I should point out, actually, one of the things that this slide doesn't include in the calculations are any charges that you might make for your services to a client. But leaving that aside, it's a level playing field as far as all other charges are concerned, and also all the investment returns are concerned. But it's an illustration as to the benefit of investing through PEPs in privately held companies. So change of pace now. Really, why lending as part of a strategy? Well, I mean, we have lending and we have solar as our 2 strategies. So immediately you've got some diversification in terms of investment strategy. And as far as I'm concerned, and a lot of people will agree with this, diversification is the number 1 rule, the number 1 mantra in terms of investment. And again, in a lending portfolio, you'll have loans to a number of different companies within that portfolio, so you're not exposed to any one failure of a particular loan. So that's rule number one. The second thing is looking at taking security. So we take security over assets of the companies that we lend to, either through a debenture where we take security over the assets of the entire business, or we have security over certain assets that we've provided finance for, and which are key, which we consider to be key assets to the business. And overall, we've got a loan to value at the moment of around 40%. So very conservative loan to value that we have within the portfolio at the moment. We've also got a track record, a history where we have, and I probably need to touch wood here, but we've got a clean book, and we've had a 100% repayment history across the loans that we've written. So I think we can provide assurance that we are sensible about the approach that we take to building a lending portfolio. We've got bags of expertise. Grey hairs mean expertise. I've worked for banks and for private lenders, as I mentioned at the outset, for a number of years. Well, my entire working career now, and more of that's behind me than in front of me, I think. We've got lots of expertise in terms of how to lend to businesses, which businesses we think are sensible businesses to lend to, and which are ones that we probably want to give a body swerve to. We're quite good at structuring deals to make our lending secure. And one particular way we do this is by having our portfolio of loans being amortizing loans, so that we receive regular monthly or quarterly repayments of capital and interest, reducing our exposure over time to a particular company. And that actually, given the sort of type of companies that we lend to, it's a good habit for those companies to get into, to actually recognize that they have to make regular repayments to you, rather than it being something that they forget about. And then it becomes a nasty shock to them that when you sort of send them an invoice for a large sum of money at the back end of a loan. So amortization of loans, really important as far as we're concerned. And the final point, and it sort of echoes a little of what Chris will talk about more in terms of inflation hedging. Interest rates, including our interest rates, will go up will tend to go up when inflation rises. So we will charge more in a period of high inflation, and we charge less when interest rates come down. And that provides some kind of inbuilt inflation hedge to how we approach our sort of lending business. Chris, Carl. I'm just going to finish up now with a couple of recent examples of loans that we've written. Both of these companies, CK International and Cryotanks, are profitable businesses, making good margins, particularly in the case of Cryotanks, but also CK International. So looking at the one on the left-hand side, first of all, CK International, the picture you've got there is a picture of a waste packaging baling machine. And CK manufacture these things. They sell them to certain customers, but more importantly, they also rent them to some of their customers over a period of time. And one of their big customers that they rent to is Amazon, who have these things installed in all their depots up and down the country, actually also in Europe as well, but focusing on the UK. And we have provided CK International with a number of loans secured against these assets, and more importantly, secured against the underlying receivable stream, the rental stream that they're getting from Amazon. So that in the event that CK International were to fall over, which I think is unlikely, but in the event that it were to happen, then we can collect directly from Amazon in terms of the security that we've taken over over the income stream that they provide to CK. And moving on to cryotanks, again, the picture you've got there are some large tanks which are full of liquid gas. And cryotanks are a supplier of liquid gas to their customers. They've got about 200 customers. In addition to supplying gas to these companies, to their customer base, they also rent these tanks to their customer base. And these tanks, I mean, it's a super business model they've got, really. These tanks have a useful working life of about between 30 and 40 years. So they go on forever, really. And their customers keep renting them more or less forever. Initially over a sort of a 3 or 4 year period, and we provided finance secured against the underlying portfolio of assets that they've got, and also the rental agreements that they've got with their customer base. A business which is growing year on year thanks to the money that we provided them with. They've probably grown 3 or 4 folds in the last 4 or 5 years. Again, since we have provided them with funding to enable them to grow their estate of tanks. I think I'm now going to hand over to Chris, who's going to talk about solar and renewable energy.
Thanks, Andrew. As Andrew and Carl have mentioned, solar makes up another part of the PEPS service. At the moment, we've got about 90 million pounds of assets under management in solar across 2 different companies. That's Solar Growth and Solar Income and Growth. And these are well-established trading companies. They've been around for about 12 years now. They are managed by Armstrong, which is a specialist in solar assets. We only manage UK solar assets. We do that with a UK team, all based here in the UK, and it's all really simple. When you invest with PEPS, you know that you're getting lending and solar. There's none of this foreign currency exposure or exposure to other more nascent technologies. So why are we excited about this? Well, renewables are transforming our electricity system in the UK. This has now become a big priority for the government. 20 years ago, there was almost no renewable electricity generation on the system. And now roughly 1/3 of the UK's energy is provided by wind, solar and biomass, and the government is strongly encouraging that to increase quite dramatically. So the new Labour government has a target of getting that to 100% of renewables and nuclear generation by 2030, which is only 5 years away. So that is a really big task. And the only way that they'll be able to do that is through tremendous growth. And we think that will unlock even more opportunities for us in this sector. They've already signaled how they're doing that through planning reform and also through additional subsidies. And we are well placed to benefit from more of those. So it's growing quickly. There's over 1.5 million solar panel systems installed across the UK. We think that's going to increase dramatically. And one of the things that we have been quite focused on the last few years is putting solar panels on businesses and doing that in a subsidy-free way. And so we're seeing that more and more businesses are installing solar panels on the roof because they see that it's a really easy way for them to both reduce their electricity bills, reduce that volatility that they get to their cost line through their electricity bills. And more of them are choosing to do it through companies like Armstrong. So what we do is we lease the space on the roof of a factory. we put our panels onto the roof of the factory with a 25-year lease, and we also, at the same time, sign a 25-year power purchase agreement. So the factory agrees to buy the electricity from the panels over the next 25 years for a fixed price, and that price is always linked to inflation. And this helps businesses reduce their energy bills and decarbonize their supply chains without adding extra stress to the electricity grid, which is really important, because that means that we're also helping the government. One of the big challenges that the government's got right now is that we need to upgrade the electricity grid to be able to handle the volume of renewables that they want to put on it. That's going to be very expensive. So where we can generate electrons at the same point where they're being used without using the grid, that reduces some of those costs that that we're going to have to bear in order to meet the government's targets. So there's just in terms of how much can businesses save, just to give you a rough feel for it, there's a general rule of thumb that all of our electricity bills, when we pay all of our electricity bills, whether you're a business or you're an individual in your home, those bills get split roughly three ways. So roughly a third of the bill goes to the company that is generating the electrons that you're using. Another third of the bill goes to the network companies for moving the electrons from where they've been generated to your premises. And then the remaining third goes to supplier margins and government taxes and levies. Now, if you generate the electricity where it's being used and you don't use the grid to move that electricity around, then you don't pay the third to the grid, and you also don't pay the third to the government. So just to add some numbers to that, right now an average electricity bill is about 27 pence per kilowatt. That means that the generator, us, we're getting about 9 pence of those 27. The grids are getting another 9, and the government's getting a third 9. If we go to a company and we say, look, you're paying 27 right now, how about you give us 12? So you sign up for the next 25 years, indexed to RPI, but we'll take your electricity bill from 27 pence down to 12. Then all of a sudden this becomes really compelling for the company, because they now have the opportunity to reduce their electricity bill by half, but they are locking themselves into a very long-term agreement, which is pretty scary for a lot of CFOs and FDs. But the savings are so big that it's compelling for most companies to want to do this, and as a result, we end up better off. So if we just put our panels in a field and sell the electricity into the grid, we get 9 pence. Now they're on the top of the factory, we're getting 12 pence, so we're better off. The company's also better off, and it also reduces the uncertainty for the company in their electricity bills and in their cost base. And particularly given the massive spike in electricity prices that we saw over the last couple of years with the inflation, with the invasion of Ukraine, our phones have been ringing off the hooks. So there's huge demand for this, and the only thing that's holding us back is the amount of capital that we are able to deploy. So next slide, please, Carl. So why solar, and how does this affect PEPs? So the PEPs products have been established for quite some time, and we're just only focused on solar. So that means that within our portfolio, we have ground-mounted solar plants, which are subsidized. So this is large fields full of panels that are putting electricity into the grid. And then we have panels on top of buildings, commercial factories, which are generally unsubsidized. Although there's a mix, some of them are subsidized, some of them aren't. And then there are also a few thousand residential panels, which are also all subsidized within our portfolio. Because our portfolio is a little bit older, we much more of it is subsidized than many of our competitors. So roughly 2/3 of our revenues are coming from government subsidies, and all of those government subsidies are linked to RPI. On top of that, all of the unsubsidized rooftop contracts with companies, most of those are also linked to RPI. So roughly 3/4 of our revenues is linked to RPI, and the remaining quarter of our revenues is exposed to power prices. But they also tend to move with inflation. They just tend to move with even more than inflation tends to move. So in terms of our performance, when inflation is very high, we do very, very well. And we've got a really strong track record as a really good inflation hedge. So why do we like solar? Well, it's a proven and established technology. Solar's been around for a very long time. Solar panels were originally developed for use by NASA, powering satellites back in the 50s and the 60s. And at that time, they were wildly expensive. Only NASA could afford them. But the reason why they've become so attractive for us is that the cost of making solar panels has declined dramatically over the last 70 years. And the reason for that is because solar panels are really polysilicon technology. So they are silicon wafers layered in between two pieces of glass and enclosed in a metal case. And as the manufacturing technology for manufacturing better computer chips out of silicon wafers has continued to increase and continue to improve, and we managed to get more and more and more circuits into each silicon wafer, that technology has been adopted by the solar industry. And so that's why we've now got a situation where solar panels that 70 years ago were so expensive only NASA could afford them. Today, they are so cheap that everyone can afford them, and most of them are being installed without government subsidies. So we think that this is really wonderful for us, and it's also very proven technology. Solar panels don't require a huge amount of maintenance, and they don't break that often. They're a really pretty good, reliable technology. Again, Armstrong has been going for 12 years now, and we are focused on solar. As I mentioned earlier, I've previously worked for some of our competitors. I was at Octopus for 6 years, and one of the biggest differences between Octopus and our other competitors is that we're only focused on the UK. We don't have other assets around other parts of the world, and that means that we can keep our asset management only in the UK. So we only use UK-based asset managers. And that's really important because when something breaks, they can be on the phone to the contractor, getting the right people out on time where they need to be. And then crucially, they can get in their cars and go out and check the work once it's been done. And most of our competitors use asset managers who are located outside the UK. But somebody in Spain or somebody in Romania or somebody in Mexico can't do that. They can't check the work once it's been done. And so that's meant that our portfolios performed significantly better than most of the other portfolios because when things break, they get fixed faster. We're on top of our production numbers more thoroughly. And that's driven really, really strong returns for us. And then we've also talked about net zero and energy security and the government's targets, and those also give us a very strong headwind. Next slide, please, Carl. So just as some examples of some of the things that we've done, so we've got Creative Solar Solutions, which is one of our SPVs. It currently owns and operates, amongst other things, an 800 kilowatt solar system on the roof space of a large factory in Holywell in Wales. And the system was installed and has been operational since 2011. It's backed by a 25-year government contract, so 25-year government subsidy linked to RPI. So we will still receive subsidized revenues for that system to 2036. And then another one of the installations that we've got is Langford Solar. This is a 13 megawatt ground-mounted solar farm in Bedfordshire. It's also government subsidized, and those payments will last until 2035. One of the things that we've recently done with Langford is renegotiated a lease extension with the landlord. When we originally started installing solar panels in the UK, probably about 15 years ago, at the time, the engineers, when estimating how long the panels would last, looked to where panels had been installed for a long time already, and that was principally in the southern U.S. So, states like California and Arizona, and since then, now 15 years later on, we've got a lot better running data for how solar panels will perform in the UK, because obviously the UK is a lot colder and wetter than California or Arizona. And that means that the panels are degrading less quickly than they did in California and Arizona. So most engineers now agree that panels will last for at least 40 years rather than the original 25. So what we've been doing with a lot of our landlords is going out and extending the leases. And this allows us to try and get a lot more cash flow out of these longer asset lives across our portfolio. It's another way that we're adding value to the portfolio. Next slide, please, Carl. How do commercial rooftops come into place? Well, we've already been over this mostly, but the key takeaway here is that there's a huge demand for this across the UK. And particularly since the spike in power prices a couple of years ago, we're continuing to see a lot of demand for this, and we're continuing to roll it out across a large number of companies in the UK. We moved into this space probably before most of our other competitors. We've been doing subsidy-free commercial rooftop installations now for almost 8 years. So we've got quite a lot of experience with this, and you know, for the new money that we're raising, this is where most of it is going. Next slide, please, Carl. And now I think it's back to you, Carl, for the summary.
Yeah, no, appreciate that. Thanks, Chris and Andrew. A really excellent and in-depth piece there, covering what's under the bonnet really with our estate planning service. Just very briefly to finish off, just conscious of time, in terms of the independent research that's out there, which is a key factor really of the due diligence that you do, just to let you know that we can provide you with the independent reporting. We do have access to that. The Martin Churchill Tax Efficient Review is probably the best known out there, and we score 87 out of 100 on that latest review, which is right in line with most of our peers. And we have been classified for the last couple of years as the top rated provider in that small cap sector, which is assets under 250 million basically. So in terms of what we do, we stack up against the majority of the competition. And we are, as Andrew mentioned earlier, we are a great diversifier if you've got clients with assets either held elsewhere, or if you look into spread an investment across a number of providers, especially with our renewable side, because whereas the majority of our competitors are based in wind energy, we do have that access to the solar. And as you've just heard from Chris, we have a very comprehensive and extended proposition in solar, so it does set us apart from the majority of our competitors. The scenario targets between 4 and 5% net per annum, again, as you've already heard, and as you can see, we're comfortably achieving that if a client goes in blended, which is basically the 3 trading companies, 33.3% in each. But it is down to you to discuss with your clients how you wish for the investment to be allocated. So for example, they could go 100% solar if they wish, they could go 100% asset-backed lending if they wish. That's down for you to discuss, and we don't have any restriction on what you do there. Just touching on, like I said, those key points, it targets between 4 and 5%, completely net of all charges. That doesn't take into account, obviously, what you may charge us. We don't know what that is going to be up front. Performance over that 5-year period, the returns at 4.22%. So again, if you look at the solar companies in particular, the last couple of years, and you look at the tax efficient review, we are the #1 company in terms of performance in that area. So we can demonstrate excellent returns. And what we're really looking to do is just give your client that really steady return. Minimum investment is 25,000. Charges into the PEPS portfolio. Initial fee is 1.5% plus 0.5 admin, so it's 2% initial and 0.5% ongoing charges. We do charge the companies that we invest into, the investee companies, and I can run through with that with you more on a one-to-one basis. But the only thing that you really clients need to be mainly aware of is 2% initial, 0.5% ongoing. And just in summary, what we offer is a really simple concept, and it's your clients can invest in there. Once it's been invested, 2 years down the line, it's predominantly outside of their estate for IHT purposes. One of the key benefits, you heard Andrew touch on gifting, which is certainly something that clients look at predominantly, perhaps ahead of business property relief at this moment in time. I love BPR because once invested, the client controls their money. They can see their investment growing year on year, but more importantly, they can access their money whenever they want to. I have to say subject to liquidity, but as you know, most companies in our sectors, including ourselves, are pretty strong in that area now anyway. So clients can get at their money should they so wish. The return profiles are excellent. We offer an outstanding hedge against inflation, and one of the unique features of our product is that should a client wish to take an income from it, they can do so, and it's classified as natural income distribution. Now, I appreciate not many clients will invest into BR wanting to take an income, but that can be a great option if down the line they, for example, go into long-term care and they may want to take income to fund that. So it's a great option, which I believe there's only a couple of providers, ourselves being one of them, that offer that service in the general market. IHT receipts are growing, so it's 5.7 billion in the last tax year. That's forecast to rise up to 7 billion. So is there a market for it? Absolutely, there is. IHT receipts are growing, and it's one of very few growth areas currently within financial services. So a lot of networks are looking to grasp the opportunity in the IHT space. Andrew again mentioned about AIM. So with the changes in that side of things, natural BR investing now is higher on the priority list, and it's a great opportunity. And watch out for some communications that will come your way with regards to what we will be doing once the consultation periods ends at the end of January. So just to tie up, hopefully we've demonstrated to you the opportunities in the BR and VCT space and what we can do to help you. I said our door is always open. We will contact you post this session just to check whether there are any questions or anything we can help you with. But I suppose the key points from my perspective are the proposition is strong and stacks up. We have 100% success rate with business relief qualification. So we've never had a case that's failed through the revenue. We have 100% success rate in terms of the asset-backed lending solar side, in terms of no client losses within the portfolio. The solar is an outstanding hedge against inflation. And we will always be in a position to give you a very detailed synopsis of where our business is and what sits under the bonnet, why it's the right thing for your client, so we can help you with reasons for recommendation, with compliance reporting, with brochures. We have all that in PDF format that we can send to you at any point. And obviously, very importantly, all of our investments, both on the solar and on the asset-backed lending, big commitment getting Andrew and Chris here today to talk to you, but that shows you that we have expertise in both of the sectors that we operate in. Vast experience, and our history and our reporting period shows that. So hopefully you can see that we will be a valid company for you to consider for your clients' investment in future. I'll look forward to speaking to you post the presentation. Either myself or a colleague will give you a call in a couple of weeks' time, probably. But if you do have any questions, please do facilitate those through to us. And we wish you the very best for the future. And thank you so much for giving up your time to join us today. Thanks, Andrew, and thanks, Chris, also. Have a great day, everyone.
Thank you very much.
Bye.
Thank you.